You know it's getting serious when a rally turns into a full-on plunge within hours. Yep, it was that kind of day on Wall Street. Hey everyone, it's Wednesday morning, April 9th, and welcome back to Capital Markets Quickie. I'm your host, Endrit Sella, here to break down yesterday's market action in just 2 minutes. Before we get started, a quick note, today's episode is sponsored by AMF Capital Asset Management Frankfurt. For tailored investment solutions and top-quality mutual funds, visit amf-capital.de. So here's the story. Stocks opened strong. The Dow was up over 1,300 points at one point, but by the end of the day, it closed down more than 300. The Standard & Poor's 500 dropped about 1.6% and narrowly avoided falling into bear market territory. The Nasdaq got hit even harder, sliding around 2.2%. What triggered this turnaround? The big headline came from the White House. They said the U.S. will push forward with a massive tariff hike on China, boosting the overall rate to 104%. Volatility has gone through the roof. This is only the fourth time in history we've seen 3 straight days where the market moved more than 6%, and the other times were the 1987 crash, the 2008 financial crisis, and the COVID-19 lows. So, not exactly comforting company. The market did try to rally in the morning. Treasury Secretary Scott Bessent announced that bilateral trade talks with Japan had started, which gave folks some hope that deals are still possible, but then the White House confirmed reciprocal tariffs will begin as scheduled. Meanwhile, China's response? We'll fight to the end. Yikes. Even some of the biggest names in business are starting to sound alarmed. JP Morgan's Jamie Dimon, BlackRock's Larry Fink, even Elon Musk, are urging caution on the tariff front. So yeah, buckle up. This week is far from over. That's it for Capital Markets Quickie. I'm Endrit Sella. Catch you tomorrow morning for more action from Wall Street. And if you're enjoying this podcast, don't forget to follow and share. Till next time, stay smart and stay invested.